class today, and we're going to talk about a plan to make $4,000 monthly on 20K of capital. So let's jump in here, and this is for educational purposes only. And real quick, this will be the launch of a new class that'll start in about a month. Class starts Tuesday, July 11th, as you can see there, at 1 p.m. Central Time. The last couple classes we did were 2 weeks, but this is going to be 4 weeks because, as you'll see here, we're going to be doing live trades every class to implement and demonstrate this plan. So I want to take 4 weeks to give you 4 sample weeks of this as we're doing it. So I'll be doing this live, and we'll be able to follow along. We will meet for 4 weeks every Tuesday and Thursday at 1 p.m. Central. Usually when I do online classes, I do Monday and Wednesday, but because I'm going to be putting on 2 to 3 different trades a week, I want to do Tuesday and Thursday, because if I do Wednesday and Friday, I don't always want to put trades on a Friday, especially short-term trades going into the weekend. Class length will be 1 to 1.5 hours for every session. Total hours of live content for this class will be 8 to 12 hours. I think it'll fall somewhere around 10 hours of live content. All classes recorded and archived. Q&A, you can ask questions anytime, 3 months after class, 4 months after class, which is nice. And then, again, live trades. Basically, I'll be implementing this, doing the live plan, doing it for 4 weeks, walking through it. And then what's nice is we don't know what those 4 weeks starting July 11th will be. And so we'll be implementing the plan during that. And the cost for the 4-week class will be $397. So that's some information. Again, it'll start Tuesday, July 11th. And this class is more designed kind of what we're going over. Again, I'm going to talk through this. Now, let me ask you, the whole key here is that we're taking shorter-term trades. And what I'm trying to do is take shorter-term trades, go out as far as I can in some instances, and put on trades that I can get out in a week, right? So, for example, if you put on a 50-day iron condor, is it usually you're going to be able to get out in a week, yes or no? If you do a 50-day iron condor, are you usually going to be able to get out in a week and maybe make 7, 8, 9%? What do you think? On a 50-day trade no, not enough time, right? So you're not going to be able to have the opportunity to make as much. So we're looking at putting on trades that we think we can get out in about a week. So the next week you'll have something on. So you're looking at, if we're doing a iron condor or calendar or butterfly, how many trades am I looking? If I do a butterfly every week, how many am I looking to put on per month? How many per month? How many trades am I looking to put on? 4, right? So 4 butterflies, 4 iron condors, whatever, 4 calendars. And so that gives you the opportunity, because again, with the shorter term trades, you have a better chance to make better yield than you do a 60-day or 70-day trade, because you can put on 4 trades. You're just not going to get a longer duration trades off that quick. So again, this is just one sample allocation of, if we had a 20K portfolio, there's many different ways to do it. But yes, every week would be 1 trade. So here's an example of an allocation of a 20K portfolio. You know, you can do equal capital allocation, but there'd be one, maybe you like butterflies more, and you put $11,400 of capital into a 25-day butterfly, and that would be 8 contracts. Now, you don't start with that. You start at, would you start at 8? No, you start at 1 contract and you get good at it. So this is just an allocation. I mean, I could put $4,100 into a 10-day calendar, which would be 4 contracts, and I'm putting it on every week. I could put another $4,500 into a 16-day SPX Iron Condor, 5 contracts. So when someone starts this plan, obviously they're not doing 20K. They're starting out with 1 contract and working their way up. But the key is what we're looking to make is about 5% per week on the trades. Now, does it mean you're always going to make 5%? No, but you have a plan, right? The plan is to make about 5%. Now, for people in our community, and we have a lot of people trading shorter term trades from 4 days duration to 20-day duration, I think 25 days is pushing it a little bit. I think a lot of times on a 25-day trade, we can get out in 7 days, but I think for the class that I'm going to be doing, 20 days might be as far as I'd go, 20 to 21 to get it off in a week. Now, again, you can do, I'm talking about 3 trades, and that's how I'll focus on the class to get more teaching in the 3 strategies. But some people might do 2 strategies that they're going to do every week. And I think for people who've traded, how many people in this session today, how many people have traded Iron Condors or butterflies or calendars with duration like either 4 to 15 days from duration, and who's done at least 30 weeks out of the last 40 weeks? So what I'm trying to get is for people who's actually done a short-term trade, short-term meaning duration is 4 to 15 days or 4 to 17 days, and who's done either a calendar, some type of butterfly, Iron Condor, but has done at least 30 weeks. All right. So I'm talking about people who've done this, just so you can get where I'm coming from with this. So people who've done these short-term trades, but they've done at least 25, 30 of them over the last year. For those of you who've done it, right, is it unreasonable to look to make 4 to 5% on your trades? And be honest, right? Is it reasonable to go after? Yeah, I mean, it's pretty normal for people that are doing this to average 4 to 5% on your trades, which on 20,000 would be about $1,000. And it doesn't mean you're always going to make it, but that's not a bad. That's a good average number with winners, losers, commissions, and everything else. All right, so that's kind of an allocation. Again, the numbers, again, and I'll make some comments on these because I don't want you to get caught up in the numbers, but this is a plan, right? The idea is that you have a plan, right? As far as the actual results, it's going to be based a lot on the market and practice, but practice is going to be the biggest thing, that you've done it, right? I didn't ask here, you notice I didn't ask how many people have never traded a short-term trade, right? And how many have never done these strategies have made 5% in a week? They'd say, no way, right? I'm taking a universe of people who are doing this, right? That would be fair. So we're talking capital of 20,000. The goal is 5% per week or $1,000, which would be $1,000 a week, $4,000 monthly, or $48,000 per year. Now, is that a high yield? Of course it's a high yield, right? But part of the reason, there's 2 reasons why it's a high yield. Options are going to be cheaper than stocks, agree, number 1. And number 2, you're trading shorter term trades, so your turnover is a lot greater. You're putting on a trade every week. But let me ask you, so really, is the goal is 1,000 a week? Well, let me ask you a question. If you make 600 a week, right, are you a failure? That's a dumb question, but I'm going to ask you. if you make 600, now, but you have a goal, right? You have a goal of what you're trying to make, and I think I set a reasonable goal, and depending on the market, depending on what you're doing, but what do you think the goal of the main thing is? Did you notice I said how many people have done this for 30 weeks, right? And really what my encouragement with the class is, and the reason I'm going to do it 4 weeks live, and I might even do longer than that. I thought of after the class is over, I might, for a small fee extra, do it another 4 weeks, because the goal is if you can do it 4, 5, 6, 7, 8 weeks, you get in a better habit. Agree? You get in a good habit and you're doing it, and it's a craft. That's all it is, folks. But the main thing is this: if you don't do it, you'll never get any good at it, right? So let's dig in. So I'm just going to go through 3 types of trades that I'll be doing. I'm going to be doing some different type of trades, not all of the trade that I'm doing, but the main requisite of this, and I think people aren't used to that. A lot of you, how many are used to doing a trade when maybe you're comfortable with the charts? Or how many of you are used to doing a trade in certain conditions, volatilities at a very high level? So how many people are more situational traders where maybe there's either the price levels at a certain support or resistance, or volatility at a certain level that they'll do something? And there's nothing wrong with that. But this type of trading, when you're short-term trades, the name of the game is theta. The name of this game is theta. We're going to put on repeatable trades over and over, tight risk management, but it's theta. You know, I'm looking to put on a, if it's a 10-day trade, get out in 3-4 days. If it's a 15-day or 20-day trade, get out in 4 days, and then, but repetitious. So here's an example, just going through a few examples of these trades. Here's 3 examples of trades I took from today. So here's a 1-year SPX price chart I took earlier today. Today's June 13th. SPX was 24.35. Are we close to 24.35 right now? Are we close to 24.35 right now? Where's SPX right now? Probably pretty close to that. But if you look at the 1-year price chart, again, we've been basically trending up. We've been basically trending up, and now we're up at the 24.46 level. So question says, so I open a position for 20 days but close it after 5. And yeah, and we'll get into Andres as far as during the class, a plan for each trade. We'd like to get a 20-day trade off in 5, but on each trade, ultimately we may be looking for 8 to 10% profit. So what determines when I get out is what's my profit target, right? And a lot of times it'll be 8 to 10%, but the key is if you go much beyond 20 days, it's going to be hard to get your profit in a week. That's really what I'm getting at. So here's a 1-year price chart in SPX, and here's a 1-year VIX. So most of the last year, VIX has been under 14. So we've been in a very low volatility environment. We've had some brief periods where we've gone over 14, but the last year we've had a very low volatility most of the time, which is normal in an uptrending market. So here would be an example of a type of trade that we would do. And here's again, this won't be the exact trade I'll be doing. This will be an example of it, but at least we can talk about it a little bit. So this would be a 20-day SPX butterfly. 20 days means the expiration. So in this case, the expiration is July 3rd. From today, that's 20 days, right? And a butterfly trade is a combination of a debit spread and a credit spread. So in this example, SPX was at 24.37. So we're either going to put it at where we're going to structure the short strike is at the money, but there is no 24.37 strike. So we'll go the next strike up, which will be 24.40, closest strike at the money. But with the butterfly, if it's between strikes, I always want to go up because that will get me less short deltas, which I'll talk about some more. But so here's the trade. Here's a sample of the type of trade. So I'm going to buy one in the money. This would be an all call, a butterfly. Buy one July 3rd expiration 24.10 calls. So if this is where the underline is, and this is the strike I'm selling, I'm buying one 24.10 call. So this is going to be in the money by about 27 points. But I'm going to sell the closest strike at the money, two of them, and I'm going to buy one out of the money, 24.65 strike. So part of, I'll get more at that during the class about extensive how we choose the strikes, but some general principles. The shorter the duration, right? Like if you look here, I'm always going to sell in these short-term butterflies, I want to sell the option that decays the most, sell the option that has the most time premium. That's always going to be the one at the money, right? So you're always in the butterfly trades that we're going to trade for this 20K portfolio of short-term trades, we're always going to sell the at the money. Why? Because it has the most time decay, right? And we're going to buy options. If I'm doing an all-call butterfly like this, options more in the money, more out of the money, I'm going to buy less premium than the ones I'm selling. And that way, that's why this is your graph at expiration. You can see, I'll explain why the downside risk is more than the upside risk. But here's your graph at expiration. Here's the zero axis. And you can see the reason you make more money at expiration at the short strike is because your short options will go to zero and you'll make all your extrinsic value time premium on that. And again, you sold more extrinsic value than I bought. So if we go to 24.40, all that rich time premium, again, I sold more time premium than I bought, that'll go to zero, and that's why you make money, because that's the one you're selling. So you would like it ideally to go to the short strike. And again, Randolph had a question, would you do a trade like this the day before Fed? Generally, yes. And during the class, because we'll be doing these trades live for 4 weeks straight, I'll explain a lot of the reasons behind it. But in most cases, I'm going to put these on. I mean, there's occasionally some big event, but let's face it. Could you find a reason, if you look at the news and you look at websites, could you find a reason to stay out of a trade every day or to stay out of the market? Is there enough news out there that could scare you to stay out of the market? Yeah, it always is. So what we're trying to do is put on positive theta trades. Again, we're selling the at the money. That's going to decay quicker, in this case, on an all-call butterfly than my in the money and my out of the money options. And they're very simple. And what's nice is you're going to put the same trade on every stinking week. We may tweak it a little bit, and I'll talk about those tweaks, but this is the general. We want to get the deltas close to zero. And I will give guidelines. 0 to 3 deltas, it gets close to neutral. And I'll get into that more, but for me, 0 to 3 is going to be close to close to neutrality. This trade is a positive theta trade, and that just means that this is a theoretical number, and it says I'm going to make about, if this is about $1,100 and $3,500 of capital to do this trade. It's about $1,135 of capital. That's the downside risk. The upside risk is $635. You say, why is that? Well, it's because if you look at it here, the width on the downside, right? If I'm selling the at the money, the strike below it would be the downside, the 2410s. So I'm 30 wide there, and the difference between this strike and this strike would be 25 wide. So I'm 30 wide, the butterfly on the downside. I'm only 25 wide on the upside. That's why I have less risk on the upside. But the reason I do that is to get the deltas closer to zero, right? If I did a balanced butterfly, I'm going to be two short deltas, and I want to keep it kind of around a couple deltas. But again, anyways, what we're going to focus on for the 4 weeks is just this craft of every week putting on a butterfly, and what are the things we're looking at, and what's the plan? How do we set it up? Do we set it up a little differently when VIX is 10? Do we set it up a little differently when VIX is 15? How about when we're at all-time highs versus what if when the class starts in a month, SPX is backed off 150 points? So that's the setup. Then we're going to talk about, what's the plan? What's our profit target? What's our max loss? If we're going to adjust, when do we do it? How do we adjust it? And then we'll do these trades together for 4 weeks. I'll put them on live. You can see them, but it's that craft part. Do you see what I'm saying? It's just getting used to doing it over and over again. And if you do an all-call butterfly, it's going to be a debit trade. If you do an iron butterfly, it's going to be a credit. Now, it doesn't matter whether you do, here I'm doing all calls. If somebody did all puts or an iron butterfly, it's okay. Do you like vanilla ice cream? Do you like chocolate? Or do you like, strawberry? Whatever. So the goal with these short-term trades is get them off in a week. If this is 20-day and I put it on every Wednesday, the nice thing with weeklies is you can come in today, if you look at your broker's platform, and put on a 20-day trade or a 15-day trade or a 35-day trade. But I want to go out as far as I can in some situations, but get it off in a week. That's the key. I want to keep the deltas near zero. State is the name of the game. Volatility is important. Again, what does this vague of -105 mean? It's kind of it's a theoretical number, but what it means, folks, is this. It means that, again, volatility measures the time premium part of an option, and these at-the-money options are going to have the most time premium. Your in the monies and out of the monies will have the least time premium. So this vague of -105 is saying, again, I'm selling more time premium than I'm buying. So if volatility goes down, I'll make money. Why? Because I'm selling more time premium than I'm buying. So if we shrink the time premium because I sold more of it than I bought, I'll make some money. Conversely, if the volatility goes up, I'll lose money. Why? Because I'm selling more time premium than I'm buying. If volatility expands, I'll lose more because I sold more of the fat time premium. Now, so what this vague of -105 means, again, it's a theoretical number. It's saying -105 means if, and this doesn't happen all the time in real life, very seldom exactly, but saying if this option volatility goes down a point, in this strike, the 2440 volatility goes down 1 point. In this strike, the 2465 goes down a point. If all three of these strikes, volatility goes down 1 point, it's saying I'll make $105 theoretically. Why will I make $105? Because again, I sold 2 of these with the most time premium. So if volatility goes down a point on each of these, I'll make more on this than I lose in these 2. Why? Because I sold the options with the most time premium, and that's what volatility measures. It's a measurement of the time premium. Does that make a little sense? You got to get used to it, but I think as we do these trades live for 4 weeks, you'll get used to it. If you've never done it before, this will be a little challenging, but I guarantee you, if you do the class and you do it 4 weeks in a row, you'll get more comfortable, right? Now, so that would be a butterfly, right? So we're making money because we're selling the at the monies with the most time premium, and we're looking to get out of this trade in 3, 4, 5 days. We're looking to make about, I'll just say this, just this part of it, we're looking to make 10%, 8 to 10% on our margin or our capital of the trade. And in this trade, your downside, whatever is your biggest risk, your downside risk, so it's $1,135. So if I'm trying to make, what's 10% of $1,135? What am I trying to make? What am I trying to make on this? If I pay $1,135 debit, how much am I trying to make? What's 10% of $1,135? Rick says $113 or so. But let's round it to 110. So if I pay $1,135 debit, where will I put an order at my brokerage firm to get out for a 10% profit? Where will I put my order in at my brokerage firm to get out at a 10% profit? How about a 1245 credit? Thank you, John. Yeah, right? If I paid $1,135 debit and I'm trying to make on margin of $1,135 roughly around 10%, it'd be $110. So if I bought it at $1,135 debit and I sell it at $1,245 credit, does everybody see that? If I'm buying it for a debit, I want to sell it higher. If I'm selling it for a credit, I want to buy it lower. Andrew, Andres, what bothers you about this one? So I'm paying, sometimes how many people get a little confused with the debit credit stuff? How many people get a little confused with the debit credit stuff? If I'm buying a butterfly for a debit, I want to sell it higher. If I'm selling a butterfly for a credit, I want to buy it lower. Now, let me just, again, I'm not getting into everything, but let's say I didn't want to lose much more than 10%. At what point would I start? If I'm paying $1,135 debit and I don't want to lose more than 10%, when this butterfly is trading at what price will I start getting nervous and want to get out? And I'm not even getting into adjustments. I don't want to lose more than 10%. When that butterfly, gets to around, like Ned said, when it gets to around 10.25, I may have to sell it for a credit. If it gets around 10.25, I don't want to lose much more than I make. So again, very disciplined risk management, but that's a little bit into the life of a butterfly. Obviously, when we do the class for 4 weeks, we're going to get very, excuse the expression, anal and get into the nuts and bolts about how to trade it, how wide should the strikes be, what time do you put it on, when do you do this, but we're going to do it together. So I'm going to put on, let's say butterfly, calendar, and iron condor. I'm going to put 3 trades on every week, just like we would, right, to show you how I would do it. All right. Any questions on that? Any questions on the butterfly before I move to the next one? Obviously, I don't have enough time to get into all the risk management of it, but any general questions? And this is SPX, which is one of the more popular vehicles. Now, Steve, we'll trade some RUT, some SPX, but I may do some stuff. There's nothing wrong with some of your very liquid stocks, but it's hard to beat something like an SPX or RUT because SPX and RUT are going to be less volatility than most of the stocks you guys trade that have a lot of options on it, right? I mean, SPX is a very low volatility. It's diversified. There's 500 stocks in it. RUT is 2,000 stocks in it. You can do it in E-minis, Mark said. Yeah, E-minis will be good. I mean, it's a different game because you're trading futures options. There's some little nuances there. Andre said, can you trade spot? Yeah, they're smaller capital you could use in SPY. Again, we could, now this particular trade for one contract, 1x2x1 is 1135, but we can narrow it. We can narrow the strikes if you want to trade less capital, and you could probably do it for $500 or $600 for one contract. All right, the next trade would be, and again, here's an iron condor. And I could do a 10-day, I mean, today's the example is 17 days. And so the goal would be put it on at 17 days. I want to get it off in a week. And I would diversify the durations. We wouldn't do all the same duration. But here would be with SPX at 24.36 today. I'm 17 days out. I'm using the June 30 expiration. I'm selling the 24.80 call, which is 44 points up. And I'm selling the 23.75 put, which is 61 points down. And this is where the current price is 24.36. So I'm doing an out-of-the-money call credit spread, selling the 24.80s, buying the 24.90s, a 10-point out-of-the-money call credit spread. I'm selling the 23.75 puts and then buying the 23.65 puts 10 points out of the money. I'm trying to get the deltas close to zero, right? So within a couple deltas, I'm short one delta. The theta or positive time decay would be 6 starting out, and the short vega would be 40 starting out. And this is we're in a very low volatility environment, but volatility isn't as big a component on a shorter term trade as if we did a 50-day trade. So this would be another type of trade, a iron condor. So in this case, I'm doing 10 wide credit spreads. I'm getting $1.20 credit for one contract. So my margin would be $8.80. The difference in the strikes is 10, so I have $1,000 of risk for every one contract. Subtract the credit of 120, and that gets me the margin or risk of $880. So one contract cost me $880 in capital. 10 contracts would cost me $8,800. So this is the, when I put it on, this is where SPX was 24.36. And these are the strikes, 44 points out of the money in the calls, 61 points out of the money in the puts. Again, the goal is to get the deltas closer to zero. So really, the entire 4 weeks of the class are going to be on just the nuts and bolts of getting you used to putting this thing on every week. And that's what I'll be doing, putting these 3 live trades, following them through, sending out emails for 4 weeks in a row. And then the last trade, we'll pick one in RUT. You can see RUT is a little cheaper than the SPX. This is 14.23 today. Obviously, very similar story to SPX, except a pretty good range here most of the year, hasn't it been? I mean, RUT's been in a range of 13. Basically the entire year, right? Russell's been in a range of 1350 to 1433, which isn't that bad. You agree? We've had an 80, what is that? 83-point range on a $1,400 vehicle for the whole year. That's not that bad, right? For income trading. RVX is at the low end of the range because obviously as the price goes up, volatility is lower, and so a low level in VIX or an RVX would be kind of this 14, 15 level is lower for RVX, whereas VIX low would be 9 or 10. So Russell's going to be, what, 30% or more volatile than SPX. But if you compare these with your Amazons and your Netflix and your Teslas and all those, the implied volatilities, the volatilities are a lot lower. And then here's a 10-day calendar. If we put today's Tuesday. If we put a calendar on every Tuesday, again, like butterflies, I would go more at the money. So if Russell was 1423 when I looked at this in the morning, I'd set a calendar up at the 1425. And what I did is I sold the June 23 expiration 10 days out. And I buy my long, the July 7s, 14 days out further than my short. And I'm setting it up at the 1425 strike. The debit is 590. Calendars are going to be a debit transaction, and that's your risk. Your risk is what you pay, same as a long call. So if I do one contract and I pay 590, my margin or risk is 590, right? Just like if I bought a long call at 590, that's my risk. If I buy a calendar at 590, that's my risk. Agree? And so with the RVX at 15, the implied volatility of my long option is 12.47, and my short option is 13.46. So the one I'm selling has higher volatility than the one I'm buying. You don't usually find it like that, only if the market's been going down a little bit. But here is your graph at expiration. So you can see very similar to a butterfly. You make your most money at the short strike. Why? Because even though the strike I'm selling, the at the money is going to be more expensive than the one I'm buying, because it's closer to expiration, 10 days, it's going to decay a lot quicker. And so if we close at 1425 at expiration, the one I sold will go to zero, but the one I bought will still hold value. And that's why you make so much money if it closes at the short at expiration. So again, a calendar and a butterfly kind of work the same because you're selling the at the money. And so as that thing decays, you do real well there. Whereas the iron condor, you're selling more out of the money call and put spreads. And so it's a little different feel. But anyways, these are the types of trades, folks, that we're going to be trading for this 4-week, how to manage a 20K portfolio, how to make a plan to make 4K a month on a 20K portfolio. And we'll be very specific about it. So as you're comparing longer trades versus shorter duration trades, one of the things about shorter duration trades versus like a 60-day trade, you're in the trade less. But with shorter term trades, you have more price risk. So you can't have your cake and eat it too. But the way I figure, if you're doing 60-day trades versus 7 or 8 or 15-day trades, it may take you 5 times more capital to make the same money because you're able to turn it over a lot more. But in terms of, again, should you do all the call calendar or the puts, or should you do the call butterfly or the puts? It doesn't matter. There's again, it's, you like vanilla chocolate or strawberry ice cream, you can pick it. And again, at the most on these trades that we'll be teaching during the class, we give very simple methodology. At the most, because of the short time duration, usually I'm just going to have one adjustment at the most because it's not worth fidgeting with these on a very short duration. If there's longer duration, I may fidget with them more, but we're basically going to give a very simple plan and maybe one adjustment to fix it if it goes against you, or to adjust it. As I put here, bottom line, it takes a lot less capital and less days in a trade and less adjustments. It makes a compelling argument for short-term trades. But again, I don't ever want to paint, there's too rosy of a picture. There's shorts, there's pluses and minuses. And on shorter duration trades, you have more price risk. Longer duration trades, you'll have more volatility risk. But that's why the key is we're going to take 4 weeks and work on the craft together. I'm going to do this for 4 weeks, right? But the idea with this, folks, is that you're going to be doing this for 50 weeks in a row. And if you lose, let me ask you, for anybody who's traded short-term trades, 7 days out or 15, is it possible to lose 2 in a row, to lose 2 weeks in a row? Yes or no? Is it possible to? Absolutely. That's part of the lot. What you're looking for at the end of 50 weeks is, hey, I won 40 and I lost 10. Or I won 35 and I lost 15, and I kept my losers not much more than my winners, and you got a successful plan. So, folks, that's kind of hopefully it gave you a little bit of a taste for what's going on with the class. If you have any questions about the material today or the class, I'll hang around here for a few minutes, or if you want to send me an email, dan@SheridanMentoring.com. Again, we'll be starting the class July 11th, which is Tuesday, so you can sign up anytime in the next month. Anyways, if you have any other questions, folks, you can email me, dan@SheridanMentoring.com. I look forward to seeing you in July. And thanks for showing up today, and I appreciate it. And have a great day.